All right, thanks, guys. Yeah, busy afternoon. What a perfect day to have the founder of Euro Pacific Funds Asset Management joining us on the show for the first time. We're thrilled that Peter Schiff has taken some time out of his busy afternoon to join us to give us some insight on not only today, but a little bit of a higher look at the overall market conditions following today. Maybe, Peter, it's great to have you. Great to see you. Welcome, first off. I mean, the Fed minutes just out here, the market seemingly positive on what would appear to be no change as far as comments from the Fed on this. I mean, I'll give you a chance here to have a response on what the Fed has done here today.
Well, the Fed has done a lot of damage, and they didn't just do it today. They've been doing it for a long time. You know, the minutes are really irrelevant to the severity of the problem. You know, a lot of people are trying to figure out, do the minutes mean the Fed's going to hike 50 basis points in March? Are they going to hike 25 basis points? It's irrelevant because 50 basis points is too little too late. The Fed needs to hike interest rates by much more than 50 basis points. They also need to start shrinking the balance sheet aggressively right now. But it's not just the Fed that needs to be changing policy. It's the government. We need to get rid of these $3 trillion a year budget deficits that the Fed is monetizing. The government needs substantial cuts to government spending, including entitlements. And if they can't do that, then they need substantial middle-class tax hikes. But they've got to do something to eliminate these deficits that the Fed is monetizing, because that is the source of inflation. You know, you've got some people today talking about wage price spiral. That's a bunch of nonsense. There's no such thing. They made that term up in the 1970s. Wages don't cause prices to go up. Wages are prices. They're the price of labor. Wages and other prices go up because of inflation. It's the Federal Reserve that is creating the inflation by printing money to monetize government deficits, and they're artificially suppressing interest rates because thanks to the Fed, we have so much debt. If the Fed allowed rates to return to a market level, everything would implode. We'd have a worse financial crisis than 2008 with no bailouts, and the U.S. government would be insolvent and have to default on the debt. So because they're not going to allow that, inflation is going to run rampant. It's not going to be brought under control by the Fed. I mean, first the Fed pretended there was no inflation. Then they pretended it was transitory. Now they're pretending they're going to fight it. They're not. Inflation is going to win by default, and that means you need to drastically readjust your investment strategy, because everything that worked when the bubble was inflating is not going to work now that the air is coming out.
I want to get into this a little bit more as far as, you know, what we can, you know, move towards maybe as far as investments are concerned. But I want to talk about the March meeting here a little bit first, Peter, because as we saw with the release there, the probability of 0.5%, and as you said, you know, the number here is probably a little bit irrelevant, but the probability of 0.5% versus a quarter went from about 58 down to 48 in an instance. Where do you think they should be going at not only the March meeting, but going forward?
I mean, rates should be higher than the inflation rate. I mean, so what's the inflation rate? The inflation rate, the way the government is now measuring it, is 7.5%, but that's a lie. If you look at the import-export prices that came out today, that's more reflective of what's going on. Export prices rose 15% year over year, 15.1. 15% is more what the inflation rate is. In fact, if we were measuring prices using the same CPI that we used in 1982, which was the last time we had an inflation rate as high as 7.5 year over year, if we still use that CPI, we would be at 15%. So interest rates need to be higher than the inflation rate, because you need a positive real return. When you are lending money, you're not doing it to lose. You need to get a return that is higher than the rate of inflation. And so that's where the Fed needs to go. So all this talk about 0%, a quarter, 50 basis points, 1%, 2%, it is irrelevant. That is highly stimulative. You have massively negative interest rates. It is highly inflationary. So if the Fed raises interest rates by 50 basis points, they are still pursuing a loose monetary policy that is extremely inflationary. They will continue to throw gasoline on the fire, even if you want to pretend they're throwing less gasoline. But I would say they're throwing more, because the rate of inflation is rising faster than the rate hikes. Remember, in December, the year-over-year inflation rate was 7% by the CPI. Now in January, it's 7.5%. That's your 50 basis point rate hike. It's already been obliterated by the increasing inflation.
Let's talk a little bit about how we got here and some of the problems that still exist in this marketplace. A lot of people got very comfortable with massive gains over the past, 3 to 5 years, even going back to 10 years. Why all of a sudden has earnings ratios come back into the conversation? And where can we see that going in the future to a point where, a stock that's trading 100, 200 times on earnings has now been cut 70, 80%?
Yeah, so that type of momentum investing where you just bought anything that was going up, regardless of the underlying fundamentals of the business, regardless of earnings, even if they didn't have any earnings, that worked in the environment that we were in before, which was this supposedly low inflation environment and where the Fed could keep interest rates at practically zero. We had all this QE. The Fed had everybody's back. There was a put in the market, whether it was the Greenspan put, the Bernanke put, the Yellen put, the Powell put. People were encouraged to speculate, take on excess risk. Well, those days are gone, right? The Fed is going to be raising rates. They're not raising them enough to slow inflation, but they will raise them enough to prick that bubble. And we're going to a different environment. We're going to a major long-term bear market in bonds. Long-term interest rates are headed higher. Even short-term rates are going up in nominal terms. Of course, in real terms, they're probably going to keep falling. But this is going to change the dynamic because the potential present value of distant earnings in the future is being dramatically reduced by high inflation. So what investors are going to have a preference for is real earnings today that can translate into dividends today, and they're investing in companies that have pricing power where they can raise their prices in line with their costs so they can maintain margins and increase their dividends so that the shareholders have a hedge against inflation. It's all about using the equity market to hedge inflation, to get a real rate of return, and that means value stock investing is back in vogue. It's real fundamentals. It's Warren Buffett stuff. It's John Templeton. It's, we're buying low prices, good balance sheets, high dividend yields, none of this pie in the sky betting on the come. And the problem is that's what most Americans own. Most people are overloaded in the stocks that are about to go down the most. I mean, the averages will be very deceiving because most stocks, the average stock is already down way more than the averages. But people are going to get killed because they're not going to recognize this change. They're still in the buy the dip mentality. Well, it's going to dip and then it's going to keep on dipping, right? And anyone who buys this dip is going to be in trouble because the next dip is going to be bigger. And if they buy that again, they're going to be in even more trouble. Some people might be using margin to buy these dips, in which case they're going to be flushed out with margin calls. But people have to understand how this has changed. And also the dollar. The dollar is going to get crushed. We have record trade deficits, we have record budget deficits, and inflation is going to continue to erode away the value of the dollar. When people thought the Fed was going to fight inflation, that's what propped up the dollar. When they realized that inflation already won and there is no fight, that the dollar is going to get killed, we're going to have endless inflation, then it's going to be a rush out of the dollar. So it's not just out of momentum stocks, it's out of U.S. It's out of U.S. stocks, it's out of U.S. bonds. So you got to be invested in foreign value, foreign dividend payers, emerging markets, stocks with commodity exposure, stuff that does well in an inflationary environment.
Let's talk about a couple of those areas of the market. I want to mention energy, first of all. Monster year because of obviously price increases in this, but a lot of these names have had pretty impressive years. And the other one, as you said, metals and gold, obviously having a very good year as well. If you're maybe just starting out now, today, with whatever size account, let's say a smaller account, how would you approach maybe dipping into these markets today?
Well, first of all, oil's had a pretty good year, but not gold. I mean, gold is up a little bit. Gold stocks are flat, maybe slightly higher. And that's because people still believe the Fed is serious about fighting inflation, when they're not. I mean, if they were serious about fighting inflation, the markets would be crashing right now. The bond market would be crashing. Things would be very different. They're not serious. And when the markets understand that, you're going to see a much bigger rally in gold, a much bigger rally in the mining stocks. So that's where people should really be focusing right now. I mean, I like the oil stocks, and we own a bunch of them. But right now, the mining stocks are going to give you the best bang for the buck. They're on the verge of a huge, I think, increase in price. So, those are the ones that should be bought right away, I think, if you're looking for a way to quickly take advantage of this. I mean, they are speculative, obviously, but I think the upside potential far outweighs the downside risk in these stocks.
Hey, Peter, thank you so much for coming on. Our chat is going crazy, and they really love everything you're saying. One quick question. You sort of just answered it. Thanks for answering about mining stocks and oil and resources. But I'm going to ask a little bit more of a broader question, and I'm not sure what your answer is going to be. When, and maybe it's not anytime soon, what has to happen for you to turn bullish on the ES? So on the S&P 500, is there something that has to happen? Is it when the Fed finally turns dovish again? Like, what has to happen for you to sort of say, you know what, maybe this is a bottom? What are you looking for?
Well, first of all, the Fed is dovish the entire time. They've never turned hawkish. All they've done is get slightly less dovish than they were before. So the hawks are extinct, right? They're like the dodo birds at the Fed. They're all doves. And the problem is, they're going to pivot again. They're going to go from less dovish to more dovish, but that's not going to be a buy signal for U.S. stocks. It's going to be a sell signal for the U.S. dollar. See, in the past, the Fed was able to bail out the markets by printing money, and that helped. But the problem this time is going to be no one's going to want the money they're printing. The epicenter of the next crisis is the U.S. dollar. It's a currency crisis and a sovereign debt crisis. So when they pivot from less dovish to more dovish, you better already own a bunch of gold stocks. You better already have your money invested internationally. I mean, look, the accounts that we're managing, even our non-gold stocks are way outperforming our gold stocks year to date, and we have very solid positive returns. Even as the U.S. market is going down, the value stocks that we own outside the United States continue to go up, continue to make 52-week highs in the face of this decline. We've finally had this decoupling where the U.S. markets can fall and foreign markets can rise. But what would actually make me bullish on U.S. stocks? One, much lower prices, right? So the U.S. market is ridiculously overvalued. I can get much better buys internationally than I can here, much lower PEs, much higher dividend yields. So as long as the U.S. market is expensive, I have no interest in it. So the market needs to come down a lot before it's going to pique my interest. But number two, what I really need to see is a complete 180 when it comes to policy. We have to understand that the Federal Reserve has been the source of our problems, and we can't lean on the Federal Reserve as some kind of economic crutch because it actually debilitates the economy and creates a dependency where the economy then becomes dependent on the crutch of cheap money. And when you do that, you distort the economy, you get a misallocation of resources, you get malinvestments. The economy is a mess because of central banking and big government. So what I'm going to need to see is a return to sound monetary policies. I want to see major cuts to government spending. I want to see the deficits brought under control, cuts to entitlements, higher interest rates, asset prices down. I want to see Americans saving again. I want, production, exports. If I see the fundamental problems fixed, and at the same time, we have good values, which we will have, because in order to right the ship and get us back on track, we are going to have to go through a protracted economic downturn. Unfortunately, there's no way around that. It's like, if you're a drug addict and you're going to kick the habit, you're going to rehab, right? And, rehab's not like going to, Club Med. It's tough. And we need economic rehab. We need to get the monetary heroin out of our system. And so when that happens, if it happens, I'm happy to buy U.S. stocks when they're really cheap and take advantage of the positive reforms that have been made. But as of now, I have no idea if we're ever going to do that. So I'm going to sit back and watch, but I'm going to make a lot of money observing this, investing overseas, being in foreign stocks, foreign currencies, right, precious metals, emerging markets. I mean, we're going to crush it in these stocks. I mean, if you go back to the last decade, from 2000-ish to 2010, it was a disaster. It was a lost decade in the U.S. Investors made a lot of money, though, internationally, in commodities, in emerging markets, in gold, just like they did in the 1970s. The 1970s was a horrible year for stocks adjusted for inflation. It was a great year for foreign stocks, commodities, gold. we're on the beginning of another huge decade for international investing, commodities, and things like that. It's going to be bigger, I think, than the 70s and bigger than the 2000s. The U.S. economy is in far worse shape than it was in either of those periods. We have much more debt. So the dollar is far more overvalued. The U.S. markets are far more overvalued. So I think the real losses for people who remain in U.S. assets, particularly fixed income or bonds, even more so than a lot of stocks. But obviously, a lot of these momentum stocks can just go bankrupt and people can lose everything in a lot of these money-losing companies. But I think the losses for people who remain in the U.S. will be bigger in term adjusted for inflation, whereas the gains that investors will receive because they were smart enough to get out of Dodge and get their money into the same markets that I'm investing in, I think the gains will also be much larger than what investors who made that switch have been rewarded with in the past.
Peter, wow, I mean, amazing coverage right there. My heroin is the buy key, so I got to remove that, go to rehab and get that off my keyboard here. But in all seriousness, Charlie Munger just came out and said about missing the run-up in Bitcoin, and I know this is something that's near and dear to your heart, obviously, missing the run-up and actually calling it a disease, Bitcoin, so on and so forth. Now, my question to you is, he also, we know, likes opportunities in Alibaba, in some of these Chinese markets. Are there companies like that? And I know you're talking about going into foreign investments. Isn't Alibaba or something with such low PEs of around 10? I have the daily chart up here, actually, if you guys want to show it just really quickly. Alibaba did peak out earlier on in May, and that wasn't even the high of 240. We're all the way down to 120, literally cut in half now, down to 110. But I wouldn't be the people's trader if I didn't ask you about Alibaba or some of these Chinese names. Are there any of these names that maybe you're getting?
We owned Tencent for a while. We owned Baidu. We got out of those stocks. We took some really nice profits in them. And they're still on our radar. They may have some more work on the downside because, they're going to get caught up in the tech wreck. But yeah, I mean, some of these Chinese tech names are going to be interesting investments. And I'm sure we'll, reposition in those at some point, probably far earlier than we might get into U.S. names. But, the Bitcoin, you mentioned that. That's just another bubble that was inflated during this mania. I mean, massive malinvestment in the whole cryptocurrency sector. The whole thing is, gigantic, a Ponzi. It's a pyramid. It's a chain letter. It's not viable. I mean, did I miss the run up in that? Did I buy it and take advantage of it? No. I mean, I missed it. And the reason I missed it is because I understood it. I understood it from the beginning. That it wasn't going to work as money, that it wasn't viable, that it didn't have any of the qualities of money, that it wasn't that it wasn't digital gold, it was fool's gold. What I underestimated was the intelligence of everybody else. I mean, people got conned into believing this nonsense, and it was a combination of greed and ignorance that helped propel the bubble. And so, yes, there are people who made and are making a lot of money in crypto because they're able to take advantage of other people's greed and ignorance, and they're able to sell. And the only people who are going to make money in Bitcoin are the people who sold and the people who are selling. The people who are going to lose everything are the hodlers, the people that bought and never sold. They're going to ride this thing down. This is a zero-sum or a negative-sum game. The money that some people make in Bitcoin or any other cryptocurrency is equal to what other people lose, minus like the VIG, all the transaction costs, all the advertising money, or whatever else they spent trying to pump this thing up so they can dump it. But what's unfortunate is how the financial media has legitimized this whole thing, and they cover this like it's actual investment. It's not investing. It's just gambling. It's got nothing to do with investing. And you see networks like CNBC cover this thing, legitimizing it. They better lawyer up because they're going to get sued as a result of what they've been doing, I think, especially if you look at the coordinated effort between the advertisers and the network and how they've completely turned the network into an infomercial for cryptocurrencies. And, they're leading their viewers, down this primrose path to bankruptcy. But it's unfortunate because a lot of the things that some of the Bitcoin pumpers are saying are correct on the economy, on the criticism of the Fed, on fiat money. In fact, a lot of this stuff these guys learned from me, right? The same stuff I was saying was a problem. They're saying the same thing, except they've got the wrong solution. Jump into a Ponzi scheme. I'm talking about doing real things like buying gold or getting out of the dollar, or buying dividend-paying foreign stocks. They're just hyping, this pyramid scheme. And it's easy to get the price to really move up, and then they con people with the past price appreciation. But the only reason the prices went up is because people bought. And the only reason people buy is because they think other people will buy and pay an even higher price. Well, eventually you either run out of fools or the fools run out of money. But at some point, the whole thing implodes, and there's a good chance we've already peaked out in Bitcoin at just under 70,000.
Yeah, possibly.
And we'll see. I think if we crack below 30,000, we can make a pretty big move to 10,000, and then we'll see how long it takes for it to go from 10,000 to zero.
I think we're talking about the greater fool theory right there, and I agree with you on that. That does help ramp it up. We saw the same thing with Tesla and everything just going absolutely crazy. Peter Schiff, I didn't think I'd see somebody as passionate about their art and about the markets as myself, but I'm glad to have met you today. So thank you so much for coming on. I'm going to throw you back to Brendan. Thank you.
All right, take care.
Peter Schiff is the founder of Euro Pacific Capital. We appreciate your time today. We know you're a busy guy, so thank you for doing this.
All right, take care. Thanks a lot.
Have a great day. There we go, guys. Mr. Schiff himself.